Hello, this is Rusty Vanneman. I'm the Chief Investment Officer for CLS Investments, and welcome to our monthly market review. With us this month, I have Joe Smith, our Senior Market Strategist, Portfolio Manager, and Risk Manager Extraordinaire. Thanks, Joe, for coming on.
Yeah, thanks for having me.
And now you're the interviewer, so
I
take it
know.
away.
Well, hey, it's obviously a crazy month in the month of November.
What happened?
I don't know. You tell me.
Okay.
I think obviously there's a lot of questions about post the election. What's
Yeah.
likely to happen going forward. But let's just start with the basics. What did happen from the market standpoint?
Well, the market has been really exceptional since the elections happened. We've seen some extraordinary moves in a variety of asset class segments and strategies, and really all of it has been on speculation.
Right.
I mean, what has really changed the underlying data? There were a lot of positive trends coming into the election that's still in place, but really a lot of it's been just based off election rhetoric. And so political markets have short legs. Would expect a lot of that to kind of unwind until things kind of settle down. Our portfolios relative to peer groups have actually held up pretty well over the last month, though there are some things that worked really well and some things that didn't work so well. One thing that didn't work, I'll just kind of throw it back to you since you managed one of our successful international strategies, is that the international markets, their reaction to the election. Talk to us a little bit about that.
That's a really good question. Obviously, with a lot of the rhetoric, especially focused on trade and emerging markets, that definitely has been a place that suffered a little bit, especially in terms of the volatility after the initial election. Personally, for myself as well as many others on our international-based portfolios, I think it really was more of a buying opportunity. Obviously, emerging markets have been, at a deep discount over the last couple of years versus historical averages from a relative valuation standpoint. But just seeing where those buying opportunities were, I think it was really at the margin a great opportunity for us to be adding.
Well said. And related to that, it kind of comes in the way we manage money. So things that we like that we're probably kind of slowing down a little bit on because they had such tremendous runs were some of the things that the moves we made earlier in this year, which have worked, the moves from larger companies to smaller companies, the moves. We went from an underweight in financials to an overweight. We went from growth stocks to value stocks. All of these were things we made before the election. They've done great since the election. We still like them, but they had such moves, we might have to let them kind of come back to us a little bit. Another area to talk about is fixed income. We're always taking questions. We're on the road talking to clients and talking about how how scary it is if interest rates rise. Well, the 10-year Treasury just rose 1%. That's a massive move.
It's a really big move.
In a short amount of time. And the overall bond market obviously lost ground, but not as much as people might think. They're still sporting gains on the year. We still like fixed income. In fact, on the margin, we probably like fixed income a little bit more. So.
Yeah, definitely a lot of buying opportunity there. Yeah. So maybe one question, and this comes up a lot from many of the advisors we talk with after the election, really has been around, what's our overall outlook on growth? Obviously, there's a lot of rhetoric out there in terms of, certain policies that are being, talked about being likely to come into play next year. But, really, from our standpoint, what do you think is the main things that our advisors should be thinking about and talking with their clients about?
Well, there was growth already in the economy coming into it.
Yep.
Obviously at the overall economic level, but more importantly, corporate earnings growth had been troughing and moving higher. That's the reason why smaller caps are doing better anyway.
Yep.
It's the reason why financials are doing better, all that stuff. So that really was already in place. We now have an administration which appears to be more pro-growth, but we don't know how that's going to happen. I think, to me, when it comes to the overall economy, there's a couple things to think about. Which are going to put a lid on economic growth. Doesn't mean negative, just a lid. And first of all, some of the more cyclical sectors within the economy have already come off their troughs a while ago. They can still improve, but how much more improvement can we get? And the other template that I'm working with, which is only going to probably get worse with the new administration, is just global debt, particularly in developed economies. Again, you can still get growth, but it has a tendency to kind of hold down growth on the top.
Yeah.
So.
Well, what do you think then in terms of, obviously talking about global debt, fixed income markets, what does that translate in terms of interest rates going forward, both domestically as well as abroad?
Well, again, I think a lot of people think interest rates are going to skyrocket higher.
Yep.
When you talk about interest rates, there's so many different interest rates. There's short-term rates, long-term rates. There's government yields, there's corporate yields. There's really so many more moving parts. What the Federal Reserve does really has a strong influence on short-term rates. Longer-term rates are influenced by market influences mostly. So the Fed's going to raise rates. I've been saying that a long time, but the Fed's going to raise rates. They're going to do it soon. They'll probably be pretty gradual about it next year, but they're going to continue raising rates. Longer-term rates, I don't think necessarily have to continue rising. We just had a huge move higher. That market is very oversold right now, which means there's been so much selling pressure that usually is a buying opportunity, at least short-term. So look, yields are still really low. It's hard to get super optimistic, but fixed income still makes a lot of sense for balanced portfolios, and we're not going to abandon the asset class by any means.
So, when you put it all together then, what's really the message, especially for many of the advisors we work with, knowing that we're effectively a risk budgeting type of shop? What's the key, set of themes or considerations that they need to take into account as they talk to their clients?
Well, I think the ultimate message always is, obviously stay balanced and stay the course. We think that global diversified portfolios make a lot of sense. If people are in a risk budgeted portfolio, it's appropriate to the situation. Stay the course with it. And just be thankful that we have an opportunity to participate in the economic growth through the financial markets, I think is the ultimate message.
Yeah, I completely agree.
Great.
And speaking of being thankful, so obviously it was Thanksgiving.
Yeah.
I don't know if, what you may have had at your house, but I had a lot of food and a lot of football.
Yeah.
So what's one thing you're thankful for?
Well, I guess, obviously, friends and family and good health, obviously. But I think even one thing to think about is investment professionals, the opportunity we have to help investors through not only the portfolios we run, but also through the education, the communication, the counsel we can provide. So I'm thankful for that opportunity that we can help people reach their financial goals. So great. Well, thanks for coming on.
Yeah,
and
thanks for
we'll
having
have
me
you back on. Of course. So again, that wraps it up for the monthly market review. We will see you next month.